All right, good morning, everybody. So this is what the hurry up and wait has been for all week. Inflation data. The energy crisis is going to jack up the month-over-month inflation data that's already been uh, bandied about, argued, disseminated. It's more of the uh, core inflation and its impact when you remove food and energy. And that is expected to be mildly higher than where it was, but still holding at a pretty sticky level. And depending on how the numbers come in today, this may or may not be impactful. We're going to have to let it play out, really. Otherwise, it is what the market has been holding its breath for all week. So, as you would expect in front of big data, we're kind of just treading water, basically flat. You can see US markets down here with Japan, everything just hovering near the zero line. Europe is up around 0.5%. You could keep your eye on that to see what happens later in the morning, but they haven't really been an influence last night, so not thinking that we're going to get much out of that when they close. So 8:30 is the big data point. 10 a.m. is the other one. At 10 a.m., we're going to get factory orders and consumer sentiment. The numbers don't look very far apart, so unless we get a surprise headline in that direction, we really shouldn't have too much of an issue at 10 a.m. But it does throw off that market truism about if we haven't broke out by 10 a.m., we probably won't until after lunch. That's something that I've picked up on over the years, and I watch for it every day. But on days like this where you're going to get data at 10 a.m., that doesn't really fit. So just watch the clock. Now, later in the morning, after we get the CPI data, you could swing back and look at the Fed Watch and see what the market's doing with it. From when I was looking at this the other day, they had unwound all rate cuts until next year in January or March. There just wasn't anything else in there. Now we can see they're putting in some rate cuts. Now this is March for next year, but even going to December or October, you can see how they're beginning to price in some cuts. It's not a lot, but we had nothing. So now there's a little bit, and that's part of the reason that we're still holding up at these levels, even with the weakness. And if you've caught any of the headlines this week, we've had multiple days of not selling off. This is a big part of why. They can give you all kinds of other headlines about the why, but at the end of the day, if the market is beginning to price in Fed rate cuts, that's going to help keep things afloat, even on those days where it looks pretty nasty out there. In fact, I've seen multiple people this week asking questions like, how is it still up with these kind of headlines? When those bad headlines foster in bad news as good news being that we could potentially get a rate cut, then that's why those negative headlines didn't drop the market like you would have expected. Right? So it all kind of ties together when you understand more about the various pieces that are out there. Right? So after the data today, just take some time later this morning or even this afternoon. There's no rush. Come back, cycle through the various Fed dates, and just see how the market is pricing those cuts. Yeah, the light bulb comes on, huh? You know, TGIF, guys. It's been a week, right? Made it to Friday, so cheers if you're still at it. 6,800 for the reference price on the SPX close. Depending on how the ES is positioned when we get closer to 9:30, keep your eye on that very large level 6,800 and whether or not the SPX is going to open above that level or below that level. If it opens above it, obviously it's going to have that level below as a bit of a structure to help hold it up. And if it opens below that level, then it's going to be a ceiling or a resistance level that it's going to have to fight through if it wants to continue to go higher. White House risk at this point this morning is really low. Not seeing too much until we get to this policy meeting with open press at 3:30 this afternoon. That could cause some violence. So again, it just, brings us back to watch the clock. So on a morning like this, CPI, PPI, non-farm payrolls, those kind of mornings, we have the opportunity for a liquidity gap. Now, I've shown this so many times, but it doesn't hurt to go back through it again. We're not talking about a gap in price, right? We're talking about a gap in liquidity. Newer traders, this might confuse you, but at the end of the day, it's a really big bar. Price moved so fast that it doesn't have your typical orders in the queue buffeting it on each side. It outran all of that. That creates a liquidity gap, and it can fall back through those liquidity gaps or rise up through those gaps. And so price ends up going back to where the candle started. Now, these candles can happen at any time. Headlines, uh, economic news events, intraday, after hours, it doesn't matter. But when we have an economic calendar event, we know when we could get one. And previous CPI days have shown us that on a CPI day, we could get one of these candles. So I've got some snapshots here of previous events because I think explaining something like this helps if you have a picture of what it is that we're looking at. So this was a CPI. I took the picture August 10th, but I don't think that was the day that the CPI happened. It was just the day I took the picture. The thing is, you can Google CPI dates going back decades if you wanted to, and then just marking those out on your chart, or at least hunting them down and seeing what happened that day. So we're looking for an outsized bar. For me, if I'm going to use it, I have some conditions. I don't want price having gone the other direction, so no real wick going the other way. And I want price to close in the last 25% of the bar. So if we was to take this one bar and cut it into quarters or 4 pieces, I want it to close in the upper 25%. Now, if it was red, then I'd want it to close in the lower 25%. Now, in this example, price never made it back down here. And I start with this one every time because in the other examples that I'm going to show you, everything worked out really well. And I don't want it to seem like it's always going to work out really well, right? Just because we get the setup doesn't mean we're going to get the follow through. So when this big candle hits, after it's done and it's closed, you can use your quadrant tool and mark out the high, the low, the 50%, and then you can measure from that and project 50% and 100%. That's what we hit up here. 50% projected of this candle. When price faded back through the middle of the day, it tagged the midpoint of that candle, the half back. So this one never closed a gap, but this one did. Notice the same conditions, no real wick going in the wrong direction. It closed in the upper 25%. It didn't really establish much of a base once the candle was made. It just immediately started working its way back to get that gap close. It did pause around the 50% mark, and it got the gap closed around 10:30 or 11 o'clock. You're going to hear that frequently, by the way. This takes hours to close. Here's another example going the wrong way. No real wick. On the opposite end, it closed in the lower 25%, built a little bit of a base, paused on the halfback, got the gap closed around 10:30 or 11 o'clock. Another CPI day, no wick going in the other direction, or at least not much of a wick. This one had multiple candles. So the first push closed in the upper 25%. Then we had a doji bar, or a pause in between. We basically was just trapped in the wick of the big bar. Then we continued the push even higher, stalled out, put in a top or a base, and then began working our way back. Got there between 10:30 and 11 o'clock. So on CPI days, CPI, PPI, non-farm payroll, we have these opportunities. Now you can trade it if you want to trade it, but you can also just use it for your analysis. And even if you don't want it for that, at the bare minimum, maybe I can help you, or at least encourage you not to try to trade in the direction of the explosion. If you'll notice, the ones that went down, we ended up going back up. The ones that went up, we ended up going back down. We didn't continue to drive in the same direction farther and farther and farther away. Even on the one that didn't gap close, we didn't just keep running higher and higher and higher and higher that day. Sure, we didn't get the gap closed, but we stalled out, set a high, and we didn't breach that high again once it was set. So, if I can stop you from buying calls on a morning like that because you think it's going to the moon, or buying puts on those red days because you think it's just going to fall all day, then good, maybe I helped you not lose some money. Of course, there are other things that can happen on these event bars. If we open and close really close, then it's not what we're looking for. There's no gap, right? If we come back to where we started before the close of the bar, price doesn't have any gap to close. So this is not what we're looking for. Having said that, this bar isn't worthless because we can still measure the high and the low of that bar, mark its midpoint, and project above it or below it 50% and 100%. You can see how price had topped out and it wasn't able to get through the 50% of this bar. Here's another example of what we don't want. Big wicks on each side, price closing near where it started. If there was any gap at all, we got it closed really fast. And even though that was a red bar, price went up. So again, trying to encourage you not just to run out there and buy puts just because it's red, or buy calls just because it's green. If we measured this bar and projected it 50% and 100%, it's what price tangled up against. Even on the retrace on its way back, we hit the mid and price responded to that as well. Another example of what we don't want. Big bar, lots of violence, price came right back through the bar. So there's no gap to play, but we can measure that bar, mark its mid, project price from it 50% and 100%. So this is what when I refer to a liquidity gap, this is what I'm referring to, right? That way you'll know if you see it in the chat, you hear me mention it. Now these liquidity gaps can happen all over the place, middle of the day, middle of the night. As long as we have price and surprise, then these can happen. But on economic events, we know exactly where it could happen, and so we can be prepared for it. So I just wanted to get that out there. If you've been here before, you've more than likely heard that more than once. But, it's just good to circle back through and cover it again. All right, overnight volume 76,000. The average is 50, so 76 feels a little better than average, but what we've had in the last month or so has been pretty heavy. 200, 180. So this feels kind of light compared to that, especially with the idea that we've got economic data this morning. Typically, in front of a big event like this, we will see them do a bunch of hedging and they'll sit out and wait, right? Why participate? Why jump in front of a train? And yet, they didn't sit out and wait. They were in there participating in 76,000 in the overnight. They were getting it done. Now, granted, they didn't go anywhere like a hamster on a wheel, just sitting there running in a circle. But they did put some work in last night. Got the ADR lines this morning. These ADR lines are a representation of the average. It's what we have been doing over the last month, right? It's a 21-day average. So in the last month, on average, we've moved about this far on a day-to-day basis. The reason that it's like this through the middle of price is because that's what price generally does, right? It gives us some upside, it gives us some downside. We don't just get a straight direction all day, right? Some down, some up, some down. You get the idea. So as long as we don't get overly bullish or we don't get overly bearish today, we should just maintain in between these two lines. If we happen to get bullish or bearish, bull case would run us up to 69.84 and bearish would run us down to 67.32 cog line down here. They're not hedging this morning. I mean, they're always hedged. That's a given. But they don't have additional hedges this morning. It seems like they're not concerned about this data print at all. Now, it might be because they're so heavily hedged because of the energy crisis that they didn't really need even more of a hedge now. And that makes sense, right? It's been a wild week, lots of headlines and deleted tweets and all kinds of misinformation and shenanigans, it would not surprise me at all that they are as hedged as they could be and that they just don't need more. It makes sense. But I would watch for the unwind of any of that particular hedging through the morning once we are done with this data print. Today's floor pivot is higher than yesterday. That's bullish. Price opened above it, and that is bullish. Yesterday was an MDP. We can count it now because yesterday is done. Wednesday also was an MDP. It's a missed daily pivot. Now, so far today, we have a MDP. That's a missed daily pivot. But today doesn't count. We can't count it until the end of the day when we look back and say, hey, look, we didn't hit that thing. For now, it's a potential missed daily pivot. And it has a lot of weight. All right. There's the guy on YouTube, if you was to search missed daily pivots, that goes into a lot of discussion about these and how you can use them in your analysis. Now, I believe he trades that way too. I don't trade that way personally. I just use them for analysis, but to each their own. What it's basically encouraging or highlighting is that this run up has been done with a lot of strength and that we haven't faded back enough to tag that pivot. If you think about the way price moves, right? It's just general market logic. We don't generally just run straight up, right? We run up, pull back, run up, pull back, run up, pull back. You get the idea. Well, on those pullbacks, if we pull back too far, we will hit a floor pivot, and then it won't be a missed daily pivot anymore. These pivots have been around for a long, long time. When we change from going down to going up, getting consistent consecutive missed daily pivots has a lot to it, right? That's what we were doing. We were working our way down. Now we're running our way up and we're leaving those floor pivots behind without hitting them. So if you're on YouTube, just type in missed daily pivots. It shouldn't be that hard to find. And check it out, kind of learn a bit more about it. Otherwise, because of the big move that we had earlier this week, it did kind of mess with our floor pivot S&R levels, but we went back into a sort of hurry up and wait mode yesterday. So we just got to take a look at the lines and see what we got. I wouldn't expect them to be too radical, all things considered. Yeah, that makes sense right there. All right, so after this big move, here's S1 and S2. S3 is completely off the board, right? I'd have to zoom my chart down just to find the thing. And that's because these lines are automated. They're based on what is happened in yesterday's price action. So after that really big move on Wednesday, Thursday's lines were really far apart. But Thursday was kind of a narrow day, and so we can see that today, Friday, our lines are a lot closer together than they were yesterday. There's a little bit of a danger to that when it comes to analysis because we use like an R1 S2 or an S1 R2 logic, especially when we're continuing a move to the upside. If we was to get to S1 today, we would look for R2 to play out. But if the lines are really close together, then we can get a false trigger because we can get there really easy, and then we can overshoot them easy. At this point, though, R1 and S1 would be the first defense before the ADR half. Right? If you think about where the ADR line is above and below us, these are in front of it just a little bit. So we can get to R1 or S1 easier than we can get to the ADR. Then there's the distance. How far away is S1 versus how far away is R1? Right now, R1 is further away. That implies that the path of least resistance is to the upside. It would be easier to go up than down, or that the market is leaning to an upside move more than to a downside move. Just keep in mind, this is all math, right? There's no connection to any order flow or price action that's happening now. These lines and levels are all based on price that happened yesterday and is just run through a math formula and applied to today's levels. So, don't give it too much credit because it's not based on intraday activity that's happening right now. All right, we're putting in a third distribution now. Because of the time constraint, it's unlikely that we're going to move this point of control up to this level by the end of the day today. But that is our zone. It's about 25 points wide from 68.50 to 68.75. Once we leave that zone, it's game on. Should we break down, that'll put us back into this point of control around the cog line. It shows 68.17, but 68.11 cog line is in there. And that could wrap up our week, right? Us just holding out above 6,800. If we break to the upside, however, we can use this level that we've built out as a bit of a backstop, and we could just continue that drive to the upside. Remember, we do have some points of control to deal with. This level back here is what we're tangled up in right now. Above that, 69.30, and then 70.11 cog line up here. To the downside, if we drop below 6,800, we should be able to get to 66.50 relatively easy. Thin zones with no footprint, we can often move through those really easy. We gotta go back a second. There's our market maker move. Maybe they're just a little slow to get going. They are hedging. It wasn't there before, but it is now. So they have started to pick up additional hedges for CPI. Now, on the one hand, that does imply that if we get outsized data, we might not get an outsized move after all, because the move comes from them being caught off sides and then scrambling to get a trade closed or opened, right? If they're feeling the pain and they're all scrambling to close at once, then price gets really jacked up because everybody's trying to get out at once. Or if everybody's trying to buy at once, then price gets jacked because everybody's scrambling and hitting the button at the same time. So notice how it just dropped back to zero. This is happening right now. They're going from, no hedge to hedge. It's just barely hitting the trigger. We'll swing back by there before we're done. See if it's stabilized a little bit. 10-day, 30-minute volume profile in TPO. We can see that shallow area that I was referenced earlier, 66.22 is the point of control below that 66.50 level that I talked about out on the hourly. So if we drop below 6,800, getting back to 6,650 and overshooting that into 6,622 would not be a surprise at all. That'll be my target. I don't see what's going to help us out in that 150 point dead zone there. There's just nothing there. Now, there's possible that we could hit something on some other chart, right? VIX, for an example, will be rising as this is falling. VIX could hit a resistance level, or crude could be spiking while this is falling, and it could hit a resistance level. And of course, they're inversely correlated, right? If VIX hits resistance and begins to fall, this will begin to rise. So it would pivot somewhere in this dead zone. So just because there's nothing here doesn't mean we can't pivot somewhere in there. We just don't have any footprints of our own. It's going to have to be from a correlated or an inversely correlated market, finding some structure in that dead space. Don't dwell on it, it'll just hurt your head. All right, no new VPOC from yesterday, but it is worth noting the March 10th VPOC that we did have marked out is also yesterday's point of control. We ran up into that previous level and we built it out really well. I didn't move that line, right? It was still there. Now I'm not going to mark today's level. I'm just going to leave it from March 10th. It's not a VPOC anymore. It's just a line. But at this point, it is a line of interest. I'm going to keep my eye on it through the day today, or at least until we leave it. I don't know. Can we put a... Yeah, we could put an icon in there. Maybe. Yeah, look at that. It's a weird looking emoji, but whatever, it's there. That'll do, donkey. All right, because it's Friday, we've got next week's levels. These levels are not set yet. These are going to move through the day today as price moves. The gray line is our current price. The red and green line are separated based on time and volatility. Next week is a 5-day week, just like this week was. So time is the same. The only difference would be volatility. If the range for next week is narrower than the range that we have this week, then we know there's less volatility next week. And if it's bigger, like it is, then there would be more volatility. Now, our range this week is bigger than next week. You can see this is, and I'm not getting it to the tick perfect, just throw a box on it, drag it over, and compare it. Next week's range is narrower than the week that we're currently in. So next week has less volatility projected than this week. Now, at first glance, that might sound pretty good. The problem with that is events are volatility suppressing. CPI, PPI, non-farm payrolls. Those are volatility suppressing events. So if it's a calendar event next week, that can compress the range. But headlines and conferences, earnings, those sort of things are not volatility suppressing. Those are volatility inducing, and we can get a wider range because of those. So ceasefires or deadlines for a ceasefire, that sort of stuff can make the range bigger. Right now, there is a projection that next week has less volatility than this week. And this was a CPI week, so it should already have been pretty narrow. On the other side of all of that is the range has gotten really big recently just because of all the violence, the volatility, everything that's going on. And at some point, things will narrow, right? If you go back to a time of good times with, week after week, just climbing higher and higher, these ranges are really narrow. And we stayed in a narrow range forecast for months, right? Almost a year. So at some point, if we continue to rise off the bottom and we don't start getting a lot of negativity sending us lower again, our ranges will start to get narrower again because we're reducing volatility and reducing the expectation of volatility. I doubt that next week's narrow range is because of that yet. It's not like we've had 6 months of positive market behavior with a steady climb to the upside. We've had a week. So there's probably something on the calendar for next week causing this reduced volatility. Something is suppressing volatility for next week. And it's not CPI because we're doing that in about 25 minutes. We're 2% above the 10-week. That's a good place to be. I would like to see it get above 2.5, start getting into that 3% because I've been looking to set higher highs in this thing for almost a year, right? Go back to May and June when we set these highs at 4.5 and 5%. We've been just working our way down since then with lower highs. I'm ready for a higher high in this thing. Let's turn it all around. So 2% is not bad. Staying above 2% is kind of the norm. If I just put my mouse here at 2%, you can see that we spend a lot of time greater than 2% above the 10-week moving average. It's a good place to be. When we're that high above the 10 and we can keep it, it just shows a good, healthy market backdrop. So first, we have to get there, and then second, we have to keep it. So we're there. Let's see if we can keep it. The problem, of course, is the other one, the daily. If we get a little too far ahead of ourselves, we're going to mean revert simply because we went too far too fast on a small time frame. This is how far away from the daily 10 period moving average we are, and we're more than 2% here too. Now that starts getting us into extremes. Plenty of examples like this area here where we got above the 2, we got 2% above the 10 day and held it, but we don't do that a lot. This was when we were rallying back out of those April lows after the tariff terrors last year, right? That real violent, sustained move that ran us all the way back up to the previous highs in a short period of time. That was sustained with us maintaining our distance from the 10-day moving average of more than 2%. We don't generally get that, right? So, yeah, it's happened before. But if you look at all the other times, generally we get to this level and that's where we get shut down and we either hold there and the 10 slowly moves closer to us each day, or we reverse and run back to the 10. But remember, every day that 10 is moving closer to us. So we would have to outrun it 2% every day. We'd have to move 2% and move farther than that because it's going to move to be able to maintain that 2% distance. Not to say it's impossible, just that where's that big bullish activity going to come from? So there's not a lot of overhead left here. We can get to 3, but it's not sustainable. If we continue to drive to the upside today, keep your eye on 2.5 and then 3%. That's the distance from the 10-day moving average. It's very likely if we get to 3% today, it will become a reversal location. But that'll be the concern, right? Is that if we do continue to drive higher today, we'll run out of room. We'll just get too far away from that 10-day. All right, looking at what's going on out there, the benchmark I use is 0.5%. We really don't have anything down 0.5% or more. I mean, yeah, nat gas is down, but the VIX isn't even down 0.5% yet. But if we look at what's up this morning, we really don't have much that's up more than 0.5% either. Chips, UFO, robots, not a lot though, and not a lot of structure. The market has not been bandied about or bullied by market breadth this week, right? The sectors, the industries, the Mag 7, they have not been moving the markets. So the fact that those same things aren't really up or down this morning, it's not really all that concerning because they're not the ones that's been moving us. Now, it's not to say that they can't be what moves us today. Of course they could, but it's more likely going to be the same thing that has been moving us. Headlines and crude and VIX. Now, VIX is basically flat, and crude, it was looking a little squishy. Right? Crude is took that big drop down, and it's still hanging out down here. So not much out of crude either. So guys, watch the clock. Let's get through the data print today and see how they begin positioning for the weekend. Watch the clock, the VIX, and crude. I think those are going to be your biggest drivers. I really just don't think that the Mag 7 and the broader market breadth is going to be our driver for today. Should be easy to see that though if we do see that swell of those markets begin to pick up. So that would be a catalyst or a fuel on the fire if we do begin to go higher or lower. So what I got for you